Good morning, everyone. That's what teachers say to their class. I'm Sarah Bartlett, and I'm the Dean of the Cuny Graduate School of Journalism, and very delighted to have all of you at our school this morning. We are the only public graduate school of journalism in all of the Northeast, which is kind of astonishing when you think about it. The nearest alternative is Maryland if you're trying to get a graduate degree in journalism at a reasonable cost. So we are 11 years old, and we have 3 master's degrees, and we really, in many ways, are aligned with the mission of your organization because we consider one of our primary missions is to make sure that newsrooms represent the communities that they're covering. And so we work very hard to connect our students with the workforce and make sure that when they graduate, they actually get employed. And our track record has been very good. We have almost 60% of our students are students of color, and within 6 months of graduating, more than 75% of them are employed full-time in the journalism profession. We define that as if you have 3 freelance journalism jobs, you're employed full-time. And that, unfortunately, is the way our industry is going these days. But anyway, I don't want to take up any more of your time. I want to turn this over to Maurice Jones, your CEO, and I'm just thrilled to have you all here. Thanks for coming.
Well, good morning to everybody. There you go. You've all awakened. Well, we are happy to be in the School of Journalism, so I want to first just thank the Dean. I, for 5 years, was the publisher of a newspaper, believe it or not, and that newspaper still survives, despite the 5 years. But I, in that 5 years, gained a humbling appreciation for the role of journalists in keeping officials accountable, but more importantly, reflecting a region or a city or a town or a community back to its residents through compelling storytelling, which is what one comes to a place like this to learn to do. We still need compelling storytelling about where we are as a country and where we are in our communities. And so it is certainly my hope that this school is around for a long, long time, continuing to produce great journalists who can go out and help the American experiment and indeed the global experiment continue forward. So thank you for having us, and thank you for the work you do. We've got a treat this morning. We've got, we're going to start with Chairman Gruenberg, and then we're going to retire over here, so to speak, and have a dialogue that includes Secretary Rubin as well. So let me introduce the chairman, and then we will also at the very end, so be thinking about this, hope to have about 10 or 15 minutes at the end where you can pose questions and feedback to both the secretary and the chairman. Chairman Gruenberg joined the FDIC's board after extensive congressional experience in the financial services and regulatory areas. He served as senior counsel to Senator Paul Sarbanes, and I have to confess, one of my favorite senators of all times. And in fact, I'm almost an adopted member of the Sarbanes family. One of the senator's sons and I were classmates, and in fact, he mistakenly asked me to be a groomsman in his wedding. But he didn't make all good decisions anyway. But he served on the senators as senior counsel to Senator Sarbanes on the staff of the Senate Committee on Banking, Housing, and Urban Affairs from 1993 to 2005. The chairman advised the senator on issues of domestic and international financial regulation, monetary policy, and trade. He also served as staff director of the Banking Committee's Subcommittee on International Finance and Monetary Policy from 87 to 92, some major legislation in which the chairman played an active role during his service on the committee includes the Financial Institutions Reform, Recovery, and Enforcement Act of '89, I think we call it FIREA, the Federal Deposit Insurance Corporation Improvement Act of 1991, Graham-Leach-Bliley Act, the Sarbanes-Oxley Act. You get the message. The chairman has extensive experience in banking and finance. He served as chairman of the Executive Council and president of the International Association of Deposit Insurers from November '07 to November 2012. He holds a JD from Case Western Reserve Law School. Did you ever practice? No? So he's one of the wise ones that did not practice law. And an AB from a little small place just south of here called Princeton University, the Woodrow Wilson School of Public and International Affairs. And just on a personal note, he's just a great guy, period. We're delighted to have the chairman with us. Please welcome him.
Well, good morning, everybody. I got to say, I do feel as if I'm among friends here, and there's no more congenial audience, I think, than the people in this room. And as Maurice knows, I'm a New Yorker, both by birth, upbringing, and predisposition. So it's always a particular pleasure for me to be here. I want to thank Maurice and LISC for inviting me and for the great privilege of taking part in this program with Maurice and certainly Bob Rubin. If I may say, I have long been an admirer of the Local Initiative Support Corporation and want to make a point of saying and acknowledging the extraordinary contribution that LISC has made to community development in our country. It's my perception that LISC takes a broad view of what community development means. In addition to supporting the development of hundreds of thousands of units of affordable housing and billions of dollars of investment, LISC's vision of community development is a holistic one that includes jobs, education, healthcare, and of particular interest to the FDIC and the focus of my comments this morning, access to affordable and responsible banking services. It's an inclusive vision based on the belief that the strength and the competitiveness of our economy ultimately depend on giving everyone an opportunity to participate and to contribute. Over time, LISC and other community development practitioners have shown that their work can make a great difference. And to illustrate this, if I may, I want to start with a personal anecdote, just to distract you from the remarks to come. Now, I mentioned I grew up in New York. I'm actually from the Bronx. And my first job out of school was as an aide to my local congressman from the Bronx, wonderful man named Jonathan Bingham. Now, this was back in 1980, which coincidentally was also the year, I believe, that LISC was established. Now, while I lived and worked in Washington when I was an aide to the congressman, this was frankly the best job I ever had. I got to spend 1 week each month in the Bronx working on housing and community development projects. My parents still lived in the Bronx back then, so I could stay with my folks and spend a week working on constituent stuff. I came to know well the leading community group in the district, a group called the Northwest Bronx Community and Clergy Coalition. I suspect many of you are familiar with the group. And I also got to know the leaders of two of the community organizations that were part of the coalition. Jim Buckley of the University Neighborhood Housing Program and John Riley of the Fordham Bedford Housing Corporation. Now, there's a reason that I mentioned Jim and John. Now, as you know, the rebuilding of the Bronx over the past 35 years is one of the great and perhaps underappreciated success stories. A few years ago, I had the opportunity to visit the Bronx and see the progress that's been made. So they arranged a tour and to show us around. And when I get on the bus, who do I see leading the tour but Buckley and Riley? 30 years later, they're still there. And they took us around the neighborhoods. And block by block, building by building, Jim and John pointed out the rehabilitation work that had been done. And they could show in a very tangible way, about as real a way as you can, the enormous progress that had been made over the course of those 30 years. And for me, that tour was perhaps the greatest object lesson I've had regarding community development. Because what I saw was how community organizations over time had developed great expertise in development and finance, and just as important, how they established strong working relationships with local financial institutions, with local and state officials, and developed a process to ensure that these groups work together, pool resources, and make progress happen on a sustained basis. I share this story with you because, as I noted, LISC was established in 1980. And what University Neighborhood and the Fordham Bedford groups have done in the Bronx over the past 30 plus years, fair to say, LISC has done in localities across our country. When all is said and done, I've come to the conclusion that the single most important aspect of this business is staying with it, sticking with it, and sustaining the work at a high level over time to make a difference. Now, Jim Buckley and John Riley, who, by the way, are here this morning, and if I can ask Jim and John to stand, just for the heck of it. Now, Jim and John certainly have that commitment, and I think it's fair to say, based on a 30-year plus record, that LISC has that commitment as well. So that's my story for this morning. Now let me turn to the subject that I think is relevant here. The FDIC was created in 1933 in the depths of the Depression to restore public confidence in our banks. Our banking system had been shattered by the Depression, and to encourage people to participate in the banking system in our larger economy. Now, certainly our financial system and economy today are very different than they were back then. But the fact is that there are still millions of households in the United States that do not have access to a bank account, do not have access to a relationship with an insured financial institution. They are, in other words, unbanked. And in addition, there are millions of households, more households, that use high-cost, non-bank financial services, even if someone in the household has a bank account. And we refer to these households as underbanked. Now, the limited participation of unbanked and underbanked households in our country's mainstream financial system has significant economic consequences and is an issue of central interest to the FDIC. It goes to the core of our mission to maintain public confidence in the banking system and giving people a sense of security so that they are willing to participate. In the United States, a relationship with an insured financial institution is a stepping stone to households' full participation in the economy. Establishing a banking relationship and setting financial goals are critical steps toward financial well-being. Something as basic as an insured deposit account gives households the ability to safely deposit income. I think that's something we take for granted, but security of savings is not a small thing to a lot of households. It allows them to make payments toward monthly obligations, such as rent or a mortgage, to engage in convenient daily transactions, such as buying groceries or more durable household goods. And bank accounts also come with important consumer protections, such as those that limit consumer liability in the event of unauthorized transfers. In addition, a banking relationship can help families to save, to establish credit histories, and to obtain credit on fair and favorable terms. When delivered with attention to the needs of consumers, this bundle of services and products can help families manage their finances and achieve their goals. So for the remainder of my remarks this morning, I want to focus on the FDIC's efforts to expand financial inclusion and build the financial capability of households and small business owners. And as I do, because I know there are a lot of community groups represented here today, I would invite you to consider how this work can inform and complement the important work your organizations are doing to strengthen low-income communities. So let me start by asking the question, who is unbanked and underbanked in the United States? Now, at the FDIC, we've been working to expand economic inclusion in the banking system for a number of years now. As a starting point, we wanted to understand who's unbanked and underbanked. We thought it was important to produce reliable data that could be used not only to inform and support policymaking and initiatives at the national level, but also on a regional, state, and local basis as well. So starting in 2009, the FDIC began a partnership with the Census Bureau. Every 2 years, we work with the Census to conduct the FDIC National Survey of unbanked and underbanked households. This survey provides reliable measurements on access to and use of bank and non-bank financial services at the national and state levels and for larger metropolitan areas. In our most recent survey, published late last year, the FDIC reported that 7% of households in the United States were unbanked, lacking any account relationship at an insured institution. The survey also showed that an additional 1 in 5 households were underbanked. Together, the survey reported that some 90 million Americans, or nearly 27% of households in the United States, are unbanked or underbanked. The survey showed that the proportion of the population that's unbanked has actually fallen for 2 consecutive surveys and is now down from 8.2% in 2011 to 7% in the recent survey. So that's arguably progress. And the FDIC analysts report that the change was larger than what might have been expected based solely on improving economic conditions over this period. Still, and importantly, the survey provides ample evidence that much work remains to be done. Large segments of the U.S. population remain much more likely to be unbanked or underbanked, including 42% of households with incomes below $30,000 per year, and nearly half of African American households, Hispanic households, and households headed by a working age individual with a disability. One of the great things about the survey is we can break the survey results down demographically to get some insight into the particular portions of our population that are impacted. Now, building on the insights gained from the survey, the FDIC has taken a number of initiatives to expand financial inclusion. A key area of focus for us has been creating access to low-cost, safe transaction accounts, and let me talk a little bit about that. We began by initiating the FDIC Model Safe Accounts pilot in 2011. Banks that participated in the pilot enrolled consumers in electronic transaction accounts that relied on debit cards without a check writing feature to provide access to funds. The accounts were structured without overdraft or non-sufficient fund fees, with low or no minimum balance requirements, and with low, transparent monthly fees. What we were trying to do, frankly, was to thread the needle by relying on a debit card without a check writing feature. It's the check writing feature that is the most expensive aspect of the account for the financial institution to offer. So by setting aside the check writing feature, but providing all the other features of a full account relationship with low minimum balances, low monthly fees, and very importantly, no overdraft or non-sufficient fund fees, we're able to lower the hurdle cost of access to the banking system through a product that is economic for the institution itself to offer. In response to positive pilot results, the FDIC is focused on supporting efforts to make these accounts more widely available. Since the pilot, a number of banks around the country, including some of our largest, have introduced accounts consistent with the features of the FDIC Safe Account. FDIC analysts estimate that nearly 9 in 10 Americans today live in a county with a full-service branch of an institution that offers a safe account. In our view, making the accounts available is an important first step, but we want to make sure that consumers who would benefit from safe accounts are both aware of their availability and able to access and utilize them. To this end, we've been working in partnership with the Cities for Financial Empowerment, the Bank On movement, FDIC-sponsored Alliances for Economic Inclusion, and LISC's Financial Opportunity Centers to connect unbanked consumers with institutions that offer these accounts. And I'm going to come back to the LISC's Financial Opportunity Centers a little bit later in my remarks. In our local work, we find partners in banks, community groups, state and local officials, and philanthropic organizations that share the common goal of bringing unbanked and underbanked households more fully into the mainstream banking system. Key elements of these local efforts include providing consumers with financial education, encouraging banks to advertise safe accounts, and making sure that branch staff are aware of the account's benefits and are prepared to offer the product to customers who would be well served by them. In talking to some of the institutions that offer safe accounts, we have learned that accounts with these features have been quite popular and turn out, interestingly, to have broad appeal across the customer base of the institutions. If I may say, particularly to that magical group that they call millennial customers. In other words, these accounts appear to have significant business value in addition to their value as a vehicle for access to the banking system. I can tell you one of our money center banks provided us the data to show that over the past year, their account meeting these features is the vehicle for the largest number of new accounts opened by that money center institution. So we think we really have a tool here that really provides the potential to make an impact on this issue. Now, In addition to our work on safe accounts, the FDIC has conducted research on how mobile banking options can lead to more sustainable banking relationships. Since about half of the unbanked population in the United States previously had an account, the question of how we better retain consumers' participation is important. Now, there is reason to think that the potential of mobile financial services is significant in this area. Compared to the fully banked, the FDIC survey data show that underbanked households are more likely to have a smartphone, more likely to use it to conduct banking activities, and more likely to use it as their primary means for accessing their account. Moreover, in 18 focus groups we conducted across the country, underserved consumers indicated that they see the mobile channel as having the potential to improve their sense of control, affordability, and convenience in their banking relationships. For instance, many consumers described using their phones to check available balances prior to making purchases, to better manage their finances and avoid unwanted fees. And this, to us, seemed an important insight. It indicated that a low threshold use of the technology, simply the ability to monitor balances in your account, could have meaningful financial value. It's an example of how technology can be used to benefit low-income, underbanked consumers. In our view, one of the key challenges to the banking system going forward. The FDIC's commitment to financial inclusion extends beyond safe accounts and mobile financial services. And a third area I want to touch on briefly is financial education, an important complement to the other work we've been doing. The FDIC's Money Smart curriculum, begun more than 16 years ago, offer tools that partner organizations can use to teach basic financial information and develop financial management skills. We have modules targeted at every age group from children to older adults. Some of the resources have been translated into 9 languages, and some are also available as online self-paced courses. We have also developed materials for small businesses. They complement the FDIC's Community Affairs team's work in bringing together resources that support new and small businesses serving low and moderate income communities. The team works to connect small business owners with small business development organizations and bank partners and helps these new market entrants become bankable. I would stress that all of the FDIC's financial education resources are available for free, for use or adaptation. And based on year-end data, we expect more than 200,000 downloads of Money Smart materials in 2017. A particular focus of our financial education work has been related to youth savings. Earlier this year, the FDIC released findings from a youth savings pilot in which we worked with 21 financial institutions, more than 100 schools, and several nonprofit organizations to link classroom-based financial education with the experiential opportunity to open youth savings accounts. Experiential learning is proven to be the most effective kind of learning in this area. During the 2015-16 school year, more than 4,500 students opened saving accounts at participating banks. Now, before I conclude this morning, I want to acknowledge the important work that LISC has undertaken through its network of financial opportunity centers to establish a comprehensive approach to workforce development, and the opportunity the network offers for further collaboration with the FDIC. In April, Maurice was a keynote speaker at a conference that the FDIC hosted to bring together financial institutions, community groups, local civic leaders, and others to explore successful efforts that have been developed to expand financial inclusion. In his remarks, Maurice highlighted the role of LISC's 80 financial opportunity centers around the country in helping to increase low-income families' financial prospects by providing financial counseling, employment assistance, and help with public benefits. Center counselors encourage program participants, 42% of whom have no bank account on entry, to open an account. His remarks and the work of center staff highlight how addressing the needs of unbanked and underbanked consumers is an important aspect of LISC's work to strengthen communities, and there seems to be a clear opportunity for increased collaboration between FDIC financial inclusion efforts and LISC's financial opportunity centers. So in conclusion, so there's hope here. In conclusion, the issue of financial inclusion goes to the core of the FDIC's mission. I would encourage each of you to think about how the FDIC's financial inclusion work complements your own, and to identify ways in which we can work together to reach our common goal of making communities better places to live. We actually have more resources, more data, more relevant products, and a greater opportunity than any time in recent memory to bring more people in the United States into the banking system and the economic mainstream. It's easy to get discouraged about things today. I do say this is an area where I think we really are positioned to make some progress. The lesson from Jim Buckley, John Riley, LISC, and I am sure many of you here today, is that if we stay with it, we can make a difference. Thank you once again.
All right, we're going to thank you, Mr. Chairman. We're now going to have a little morning fireside chat. Secretary Rubin is joining us. Secretary needs no introduction, but he's my boss, so I'm going to give him one. 70th Treasury Secretary, co-chair of Goldman Sachs, co-chair of the Council of Foreign Relations, founder of the Hamilton Project, which is housed at Brookings, which is essentially a think tank type enterprise that is focused on making sure more Americans can enjoy the prosperity that is produced here. AB from Harvard, another Yale law graduate that didn't practice law, and most importantly, chairman of the board of LISC. How about that, huh? All right.
Reasonably well done.
Like I said, my boss. Anyway, so let me pick up on a theme that I think most of us have to grapple with who are working with this population. So the chairman mentioned there are 90 million people who are unbanked or underbanked, right? That's 27% of the U.S. population. Very often when you do the work that we're doing at LISC and others, this work tends to get marginalized, right? This tends to be they're working with poor people, right? It gets segregated, but our argument is this work is at the heart of the risk to American competitiveness, which is a piece, a theme that you picked up on. So you've got 3 minutes. Make the argument that the work that we do should not be marginalized, that indeed it's part of the American story and it's a risk to American competitiveness globally that we all need to embrace, if for no other reason, that reason alone.
Look, I know
It's a leading question.
Secretary Rubin, I know, is particularly eloquent on this issue, but let me say, I don't think there's, I think it's hard to overstate the importance of this issue. When you talk about opportunity cost, the missed opportunity to bring people into the economy, to take full advantage of their abilities and skills. The cost to the U.S. economy from that missed opportunity is enormous, hard to calculate, and has costs far beyond economic costs to all of us. So the value to our society of making the investment to bring all of these folks into full participation, that is whatever the investment there is will be returned manyfold in terms of the economic value to all of us, and frankly, to the nature of our society as a place to live. I don't think you can overstate the importance of that as a national goal.
Oh, okay. Yeah, I think I would add the same. As I was thinking about your comment and Marty's, what troubles me is I think you were absolutely right, Maurice, and then Marty. I think this is an imperative economic issue. The social cost that could be saved if we could bring all low-income people into the economic mainstream, the productivity that could be gained, and I'd expand that, by the way, to include criminal justice reform and the people who are being released from prisons. I spoke at San Quentin about 2 years ago, I guess it was, a TEDx talk, and it was a TEDx talk. While I was speaking, I spoke, and then somebody who spoke after me had just been released about a year ago, and he said, very thoughtful, impressive man. He said he was given $300 and a bus ticket. Now that isn't a way to take this very large population. We have 6 times the incarceration rate of the average OECD country, and bring these people back into the economic mainstream. We pay a terrible cost for not doing it. You know, more broadly, Maurice, I think there's no question that what you and Marty said is right. No matter what our incomes may be or where we may live, when you have close to 20% of our children living in poverty, and a poverty rate of 12 plus something percent, this obviously is a tremendous impediment to the competitiveness and economic success of our country. But that perspective is not very widely shared. And the question is how we get from where we are to the point where there's enough recognition of that so it has political resonance. Because where we stand right now is there simply isn't a massive failure, I think, to recognize that, and therefore a massive failure to marshal the will, political will, I guess you would say, and the public will, to provide the resources to do what we need to do.
So, keep going. How do we correct that? What should we all be doing?
Maurice, I don't know the answer to that. When I was at Treasury, we set up the first office of community development at the Treasury Department. A senior United States senator called me to his office, and he said, you shouldn't be doing this because this is a social problem, not an economic problem. You should worry about fiscal policy and trade. And I said, Senator, with all due respect, I think this is, yes, it's a social problem. Yes, it's a moral problem. But leaving that aside, I think it's an imperative economic problem. And I think the monies that will be spent on this are a public investment that will reap a return very highly commensurate with the importance of the problem. But Maurice, I do a fair bit of speaking on panels and this, that, the next thing, even sometimes in Washington. I just think this is way below the radar screen. I think one thing we could do, and you and I have talked a lot about this, is LISC is an enormously successful operation. What do you provide? $1.3, $1.4 billion in financing to inner cities, distressed rural areas. I think we could be a much more of a voice and try to break through, though it's not easy in this cacophony we have in America today with social media, one thing another. But I do think there need to be public voices that make this economic argument. And I would say, I think it's fair to say right now that that's not being done, at least in an effective way, by anybody or any place. And I think we have a tremendous opportunity to do that because LISC itself is a large and very successful and extremely well-run organization.
Let me ask.
Can I just one more thing, and I apologize.
Yes, sir.
You know, I can remember when Lyndon Johnson had the Great Society program. He made this a public issue. There have been others, as Jack Kemp, maybe not the greatest genius that ever lived, but nevertheless, he made this a public issue. But there are no political figures like that today. And I think another thing we can do for those, I don't know how many of you are involved in the political system, but we can try to get our public officials to become a voice for these issues.
Is that your opening campaign statement?
Yeah, I'm running to remain in this country and not deported under the present circumstances.
On that note, I'm going to transition. Our financial opportunity centers, which you mentioned, and thank you for mentioning it, focus on trying to get talent prepared to literally break their way into the economic mainstream. Let me come at the question from another way based on what you've seen. How do we accelerate the capability of the system, the financial system, to break its way into the folks' lives who we're trying to help transform? What do we do from the other side of the balance sheet to accelerate the growth of the system into that 90 million that you just mentioned? If the world were yours, no restrictions, no
Well,
political restrictions.
You know, the easy and obvious answer to that question, frankly, is what LISC has been doing for the past 30 years. I don't think there's a magic bullet here. And I don't think there's a law. I mean, we did pass an important law called the Community Reinvestment Act that does require banks, financial institutions, to serve the needs of their local communities. And that law has been, in my view, terribly important and really a threshold for addressing the issue of bank participation and investment in these communities, which really, I think, is your question. And I think the experience of the past 30 years suggests that bank willingness to do this actually is not sufficient. That banks don't necessarily on their own have the expertise, the understanding of the local markets to serve. And I think the great lesson of the past 30 years, the lesson of the Bronx and many other places, is that it really does require collaboration between the financial institutions, local community organizations, and local government officials. I think it's because each bring resources to the table, each necessary, but on their own, really not sufficient. You need the financial, the credit from the banks. You need the familiarity and the trust of the community that the community organization brings. And frankly, you need the resources and the clout that local officials can bring to the table. And that, at least in my experience, the three working together, sustained over time, really can make a difference. I think that's, and it's not a magic bullet, but I think that's what experience teaches us. And continuing that work, bringing more resources to the table, focusing more national attention on the issue, as Bob suggests, all would be valuable here. But I think it's the bringing together of the respective parties and pooling the resources that can make an impact.
Yeah, I'll tell you something that troubles me right now, Maurice, and that is that if you look at this tax bill that's just been proposed, it has specific provisions in it that undermine affordable housing. They'll survive or not survive, who knows, hopefully not. But more broadly, the reconciliation instructions, as you know, provide for $1.5 trillion deficit over 10 years. That materially increases what is already a very seriously negative, or increases the negativity, the negative dimension of our fiscal situation, which means it puts ever greater pressure on the fiscal resources available for public investment. And I think it has the potential for even further constraining what already is far too little effort and far too little resource available for the issues of dealing with poverty that we've been discussing. So in the first instance, right now, Maurice, I think that this is close to this tax bill, I think, is close to a national tragedy. It's taking a fiscal situation that is already deeply threatening, and just to focus on our issues at the moment, one of those dimensions of that is just continually reducing the resources available for addressing public investment in these areas and all other areas, and it exacerbates that, and materially exacerbates that through this additional deficit.
CRA was mentioned, and then we're going to turn to the audience. It's a 20th century tool. We're in the 21st century. It has been incredible. But if you could do one thing more to it to update it, what would you do?
I think it's worth updating, and I could talk about a couple of things that'd be useful to do. But let me just, as a threshold, it's a 20th century tool, it's a 21st century tool.
Yes.
I mean, let me just not, let's not lose sight of the fact that the banks are at the table because of CRA.
No question.
The enactment of CRA in 1977, and I was there almost at the beginning, and have seen the evolution over time. And the fact is there was history in terms of community development before CRA and after CRA. And CRA is a threshold reason the banks are at the table, and it's a threshold reason the banks remain at the table.
Question. No question.
And there are things we can do to update CRA, but I would start by making the point that CRA remains highly relevant and terribly important today, and very effective. And I think people focus in particular, and I'll mention it on this assessment area issue, that CRA is focused on the so-called assessment area of institutions, the geographic areas that the banks identify as serving, and ensuring that the banks serve all of the people in those assessment areas. And the concern being that with an increasing part of banking today being online, that a lot of that activity is now going outside of the assessment areas and not captured, as it were, by CRA. And I think that is an issue we need to focus on and do some work on. But I'll tell you, the FDIC has actually done some research on this issue, and it's important because the fact is that the very large majority of the lending, investment, and service activity of banks today, even with the proliferation of online activity, remains within the service area of the institutions. Most people, even who do their banking online, our research indicates still live in the assessment areas of the institution. So it's an important point not to lose sight of. The CRA remains highly relevant and effective today. That being said, the direction of things certainly would suggest that more activity is going to be done online. The potential for more activity taking place outside of the assessment area of the institution is something we need to take account of, and CRA needs to evolve so that we can give banks credit and capture the activity they do in low and moderate income communities outside of their assessment area as part of CRA. I think that's an issue we should address going forward, but I think it's important to keep in mind that it's not as if it's all taking place outside of the assessment area today. The fact is most of the activity still remains captured by the assessment areas. There's a lot of reason to try to get ahead of the curve, so I think it's worth looking at this issue, but I just want to keep things in perspective.
Good point. Let me get the audience involved here in the last 5 or 10 minutes or so. Yes, sir. I think we have a mic. This young-looking man over here with a hairline like mine. I got to go to him first. probably cousins or something.
I don't know what you're talking about. Thank you for your remarks this morning. I want to follow up, if I could, on your comments about the role that CRA has played, and you talk about the evolution of CRA. I recently had the interesting opportunity to talk to some new officials in the administration and fear the possibility of the devolution of CRA. And I wonder also if you could, you talked about the role that CRA played, but you also talked about how this evolving partnership between local government, community organizations like LISC and others, and your agency have helped to build a foundation such that you now have financial institutions telling you, both publicly and privately, that these access accounts, these certified accounts, are becoming their top sellers. And so my question is if there is a devolution of CRA, do you think we have reached a critical point in the market movement toward these consumer accounts, that there's some other way that we can continue to keep the banks at the table and keep that progress moving forward?
Well, wait a second. I'm not going to start off by conceding this thing. I think it's a matter of public record. The administration is taking a look at CRA. There's arguably a reason to do that. It's too early to tell where they may be going with it. And certainly, I don't think anything would be done legislatively. It would probably be done through the rulemaking process. And so let's wait and see, and don't assume that there's not a constructive possibility here, rather than the other way around. And look, I think we do have some momentum, as I said, in terms of making progress on this unbanked issue. But make no mistake, CRA is central to that. I mean, we give CRA credit for offering these accounts as part of the services test. We could actually do more. When you talk about things to do with CRA, I think the services test is underutilized in terms of impact. It's not just credit products, but services designed to really meet the needs of low and moderate income consumers, like save accounts, are really terribly important. And there's more that can be done in that area. And if you want to pick a third area, we have the investment test, but I really think and a lot of people have talked about this, it may be worth considering refashioning the investment test into a community development test to focus strategically around the issue of community development. And there are aspects of both the investment test and the lending test that could be combined into a community development test that would have some value. So, one, I don't want to concede anything, and I'm going to remain positive for as long as possible. And second, I wouldn't kid ourselves that we need CRA to remain in place in all the other efforts to maintain the engagement of the financial institutions. Let me say, I do think the engagement of the financial institutions has been real and very productive over time. And I think the value of the partnerships and the relationships, also can't be overstated. I think back to when I started working in 1980 and would go up to the district, and I went to those, CRA had just been passed a couple of years before, and it's hard to think of now, but banks and community groups did not get together prior to CRA. This was not a frequent occurrence. And I remember attending some of the early meetings, and it was, let us say, awkward on both sides, trying to figure out, what to say and how to communicate with each other. And it took some time, but it really was a learning curve on both sides. I meant that. It was obvious in terms of the increased sophistication on both ends in understanding how to meet the needs of these neighborhoods. So, but I do think we need to keep the public authorities in place.
We have time for one more question. Uh-oh, I got two hands. This young man, you can probably, if you can do it really quickly, we can get them both in.
That's a New York solution to a problem. Talk fast, you know.
Talk fast.
Okay, I'll be really quick.
Okay, time's up.
Understanding that the CRA is a race-neutral law, at the same time, let's say you could define local credit needs as saying closing the racial wealth gap. Let's say in Boston, where the racial wealth gap is $275,000 in median household wealth for white households, $8 in median household wealth for black households. Let's say in Boston, a local credit need is closing the racial wealth gap. Is there anything other than the political climate that stops a local CRA regulator from saying, you know what, let's try to meet close the racial wealth gap as a local credit need in Boston?
Well, you know, yeah, that's
Go ahead, Marty. take
Yeah,
that.
you know, the authority of CRA, as you indicated, is focused on serving the needs of all the communities in the service area of an institution, including those of low and moderate income. And whether it's Boston or New York or Philadelphia or Chicago, we know those communities, those low and moderate income communities, are going to be disproportionately minority. And so there's no doubt that CRA, as a practical matter, over the course since it was enacted, has focused bank lending activity in those underserved communities, which are disproportionately communities of color. So, I mean, I take your point, but I think as a practical matter, CRA has been pretty valuable in being responsive to the issue that you raise.
I'm going to get this last question in, and then we'll let you go back to your day jobs.
Thank you. So we all see LISC as a leader in innovation in financing comprehensive community development. For years...
So far, you're starting off great, my man.
Easy question and an easy answer. For years, you have shown approaches in combining what is mostly private sector capital with mostly public sector subsidy. New markets tax credit, historic tax credit, low-income housing tax credit, 9s, 4s, et cetera. As you look forward in your role of innovation going forward, what does comprehensive community development look like in a world without those subsidies?
Let me make one brief comment. No, Maurice was going to respond. Let me just say, you know, you call them subsidies, but I would say they're externalities here. There's tremendous public good to be gained from those expenditures, if you want to call them expenditures. And therefore, I think they're a public investment with a very high rate of return, and I think that it's imperative that we do everything possible to maintain them and make the case that these aren't social programs, they aren't moral programs, but they're economic programs with a tremendous return for the investment that we make.
I would just add that I think that the development finance industry in this country has been too dependent on the banks for our financial journey. I don't want to envision the world without LIHTC and new markets, so I think we should continue to fight for that. But there's a whole world out there that we're not tapping into in anything like a substantial way. The healthcare industry, which realizes that 80% of the health of its patients are actually determined by outside clinical forces, and that if they truly want to make a community and an individual healthy or keep him or her healthy, they have got to do something about affordable housing and jobs and stress and healthcare and safety. Guess who they should be partnering with? Us. The technology community that's worried about whether it will have affordable housing stock in the Bay Area where the median housing price is $730,000 plus and rising, to keep their talent that needs more affordable housing. Guess who they need to be working with to make sure that the supply of housing increases that's affordable? We need to be tapping those markets in a much more aggressive way than we are now. To some extent, CRA has been too good to us. I say that with a huge caveat. The bottom line is there are more sectors in the outside of government that we have great opportunity to partner with. And then the last thing I would say is we have fundamentally believed that this work is about local. Well, guess what? The closest public sector to local is state and local, not federal. We still have much work to do with the federal government. So while I don't relish the thought that we'll lose new markets or LIHTC or whatever else, I do relish the fact that there are far more opportunities to build more partners on the financial side than we have tapped yet. So the future's bright. The future's bright. With that, good morning. Thanks to Marty's team, thanks to the LISC team, and thanks to you all. Thanks to you. Thank you. Yeah, peace to you.
Marty, very good to see you. Good luck.
Got an election in New Jersey.